All right, welcome to another episode of the Hustle Harder Show. Today, we're going to start a new series with a new format to complement the investor interviews we've been doing over the last year. We love sitting down with real estate entrepreneurs and hearing their stories of struggle and success. And we thought it would be fun to introduce a new format that we plan to record and release every week. So the idea is to produce, more consistent content and touch on a lot of, kind of topics that are important kind of in the moment. And we'll be putting these out once a week going forward as a complement or in addition to some of the interviews with real estate entrepreneurs that we've been doing. So super exciting, really fun format. We're excited to release this and do something a little bit different. So the new format is a roundtable style. It'll be hosted by me, James Gaskin, and our founder and CEO of Renovo Financial, Kevin Werner, will be my co-host. And each week we'll be joined by, a different kind of special guest to discuss current events and news related to the U.S. economy, the housing market, and other topics that are relevant to real estate investors and those who support them. So today's guest is Renovo Chief Credit Officer Darren Weaver, alum of the show. We did an episode with Darren earlier this year.
I got a cup now, James.
He's got the mug.
Look at that.
Yes, that's what I'm talking about.
Hey, got the mug.
Look at that.
Look at that. We're matching.
We're in the club. We are in the club. I love it. So Darren's an alum of the show, and we did a kind of 2024 recap, 2025 preview of what investors can expect this year in 2025. We're about 6 months from the time we filmed that original episode. So I think it's a great time to revisit, sit down with Darren and Kevin and talk about what's going on. We can talk about some of the predictions and things that Darren had to say earlier in the year, kind of where we are with that, and pick up on a bunch of the news. This is a pretty crazy time in the world of finance and economics, and so it's very, very good time for us to be talking about current events, and we're excited to do that with our two guests today. And so let's get a couple of introductions here. Kevin and Darren both have been on the show, so I'm sure a lot of folks already know them. If you haven't had a chance to check out their episodes, please do. Kevin's was the very first episode we did. Even I learned a lot about the Renovo story from that episode. I think it's a really good one. So definitely go back and check that out. And then Darren's episode was fantastic as well. We got a lot of great feedback on that one. So check out both of those episodes. But without further ado, I'll let you guys introduce yourselves. We'll start with Kevin, and then we can jump into the news of the day.
I'm Kevin Werner. I'm a co-founder and the CEO of Renovo Financial. Proud Chicagoan, and I'm here to get after it, guys. We got to talk real stuff. Let's go.
I love it. All right, Darren, let's hear your self-intro. No pressure.
Hello, everybody. I'm Darren Weaver, Chief Credit Officer here at Renovo. Work on risk, portfolio management, guidelines, all the above, and really excited to talk to everybody today and to be on James's show.
Awesome. And Darren, you're obviously so busy working on risk and making sure that we're doing the right loans that you have not had time to put up any artwork in your office, which is a good sign. I think that's a good thing.
No artwork.
I was like, Darren, are you signing on from your dentist office or?
Yeah, no, I got a Yankees hat.
We got to get this guy some artwork.
I got
maybe some Scarface posters on the side.
I have a wooden turtle.
Sopranos.
There you go. All right.
I got some knickknacks, but I definitely need to get some art on the wall for sure.
All right, we're going to work on that for the next episode with Darren. So everybody make sure to tune in and let him know what you would like for Darren to put on his office walls there. But let's jump into some news. So, what I think, this show is going to be all about kind of talking about current events. Couple, pretty big things happened here recently. And probably one of the biggest that's made a lot of headlines is the downgrade of the U.S. Credit rating. So I believe it was Moody's brought down the credit rating from a AAA, and obviously that's a pretty big deal. A lot of people talking about that. Kevin, Darren, does it matter? What does it mean? And does it matter? Is it going to affect our customers? Is it going to affect us as U.S. Citizens? So I'm very interested to hear. There's a lot of mixed messaging right now, and hearing the talking heads on CNBC. So I'm very curious to get both of your opinions.
I think the United States has had a AAA rating since forever. I think it's always been regarded as the risk-free environment. Can't get better than AAA. They knocked us down one notch. And the reasoning behind that really has to do with not just the deficit, but just the total gross amount of borrowings on the government balance sheet. I think there's something like $36 trillion of government debt, treasuries that have been issued. And the annual deficit is, around 1.5 to 1.8 trillion. So if you think about every year that goes by, being in a deficit, the government debt will continue to grow. I think one of the primary concerns that was noted was really just as old debt revolves off, new debt they issue will be at higher interest rates. So if you think about stress, like payment stress, right, relative to essentially GDP, that's kind of the reasoning for the downgrade. I mean, a lot of the downgrade is symbolic in nature because we went from perfect to nearly perfect. So you got to look at things in kind of a relative span, but definitely important to note that this happened. And, when you compare the United States' fiscal balance sheet relative to other, Moody's calls them sovereign countries, but, Western capitalistic countries, our debt level is definitely high.
Darren, what is it compared to others? That's interesting. So what is, do you know? So like, who's an equivalent?
I don't know like the actual nominal numbers, but a country that would be similar would be like the United Kingdom, right?
They run What's their LTV?
I don't know what their LTV is, but I know it's in the same kind of proportional range, right? And a lot of the focus, I think, in terms of like normalizing, and I don't want it to be a political discussion, and there's different avenues in which this is done, but just maybe a joint focus on what contributors to the deficit are, which would be spending, government spending. That's a large, humongous portion of what could contribute to the deficit, but then also, what we're producing relative to that. And a lot of that is intellectual property or technology or other things. But there's all sorts of ideas as people, listen to the news about fiscal policies and whatever, and it's all maybe right or wrong, but I think they're all kind of attempts at trying to at least take steps to bring the deficit closer to zero.
And I think it bears mentioning here that none of us are professional economists. So, we're certainly, we're going to give you our best interpretation of what's going on, but please don't come and tell us all the things that we didn't know. And, we're bound to say something that maybe isn't exactly factual, but certainly from our perspective, the way it feels. Kevin, what are your thoughts on the downgrade? Is it meaningful? How meaningful is it if it is?
I hate to say it. I doubt it's that meaningful. These things tend to get like really blown up in the media. This feels like that right now. It's the 19th of May at 3:54 p.m. I would bet in 1 week, no one will remember that this happened. Hope I'm wrong, honestly, in some ways, because I think we do have to pay attention to a massive debt load that we have on the country and a massive deficit that we operate in. And I think Darren, what he said earlier about the real risk we have is that we have to refi some of this debt at higher rates, and it's not that complicated. We have an LTV. I don't know what the V is. I have no idea what Mount Rushmore is worth, and everything else. But there's a V, obviously, and there's a loan, and there's interest coverage, and we're not going to be able to borrow the same rates we borrowed at 2 or 3 years ago, and that's not great. So I do think we should pay attention to it. We got to figure it out. I think it's a problem.
Yep.
What are the chances of us redeeming our AAA status? Is this a long-term downgrade?
Yeah, I think so, personally. But, it's also, we went from an A plus to an A.
Yeah, I'll take an A in school all day long. A minus is totally fine in my book. A minus, maybe even a B plus sometimes. I'm good.
Yeah, exactly. Yeah.
Treasury rating, though, and corporate rating, different. I agree. So it should be A or higher. A AAA is, Darren, is it AAA is where we've been?
Yeah, AAA. Now it's,
well, the market, go ahead.
It's 2 capital A's and a lowercase a. Go ahead, James. Yeah.
Well, I know this is very new news, but the market does seem to be shrugging it off as I've been kind of watching it today. So, the market would certainly agree with you that maybe it's not the biggest deal, and certainly seems to be getting digested by the market at the moment. That certainly could change, right? The market can be pretty unpredictable and wild sometimes, but market doesn't seem to be taking it too hard. But it does seem, and I think the reason it's making a lot of headlines is it does seem to be kind of a wake-up call that, with a group like Moody's and some of the other rating agencies downgrading U.S. debt, they're kind of flashing a signal that, we're hitting some levels that, may not be ideal over time, and certainly do impact the attractiveness of U.S. securities and investments. And specifically bonds, U.S. government bonds. So it's certainly an interesting factor. We'll see if it has much impact, but certainly as we sit here, it seems like it's kind of being absorbed relatively well. But there's a lot of things going on in the world at the moment. I think obviously we've got the credit downgrade is a big headline today. But let's get into something that maybe we have a little bit more expertise in. That's probably a good idea. And let's talk about the housing market a little bit. The market seems to be, a little strained. Although we are seeing, more supply, I believe, coming on a national level. But I'm curious to hear both of your opinions on, the health of the U.S. housing economy, the housing market. Nationally, of course, gets all the headlines. But at Renovo, we're very local and regionally focused. So, would love to break down kind of some of the markets that we're seeing that are a little more challenged versus some that seem to be doing relatively well. And, kind of what's going on in those markets that might be driving some of that. So let's kick it over to Darren, and would love to hear, your thoughts on the housing market, days on market, price reductions, affordability, new supply, and then, of course, housing price strength and weakness, strength or weakness, depending on where you're at in the market. Darren, what are your thoughts around the general housing market at the moment?
Yeah, I mean, I think, if you're going online in the middle of May and reading about the housing market, you'll probably see a bunch of headlines that read something like, spring selling season is a little soft. You'll see commentary around that. I mean, the data, if you look at the number of active listings, spring to spring, because you have to look at it the same time period for over different years. But if you look at this spring relative to last spring, there are definitely more homes sitting, or slightly higher days on market on a national trend. There's more active listings than there were a year ago. But I do think that everything's relative, in that, the other major theme in housing is affordability. And affordability is driven by 2 things. It's real prices and interest rates. And we talked about the credit downgrade. It's probably going to keep treasuries elevated for a longer, stickier period of time. We're already there because of inflation. And I think that's part of the reason why the downgrade was kind of a soft blow, because we were already adjusted for it in the markets. But, on the non-rate side, you have folks that are in cheaper rate mortgages slowly trickling out, slowly selling, slowly moving, so that the level of active inventory keeps trickling up. And really, affordability is the hard part to pinpoint how it affects every region, because a lot of the inventory can be at price points that are less affordable. And so you have a little bit of a mismatch between inventory that's digestible and inventory that's not as digestible by, I don't even know what the generations are even called these days, Y, Z, X, Y, Z, A, B, C. But the younger generation's probably going to have a hard time tapping into the equity for a lot of that inventory that's available for sale. It's too expensive.
Showing your age there, Darren. Sounded like an old man
I
over
think I'm
there.
technically a millennial. I think. I don't know. So
I love it.
But yeah,
Well,
I mean, I think the themes are inventories up year over year. Rates are basically unchanged. There's a little bit of, employment softness, things like that, and some more supply generally.
Kevin, what are your thoughts? I know, there's an economist that I enjoy listening to, who I believe is with Housing Wire. That may not be the right name of the company, but Logan Mohtashami is a big housing economist.
I'm listening to that guy. I mean, come on, he's awesome.
An absolute character, to be sure. Shout out to Logan Mohtashami. When we were in the last couple of years, kind of post pandemic, and as we were sort of in this period where really very few existing homes were trading, and really all the sales volume was happening with new construction and the home builders. Logan had a phrase. He was characterizing it as a savagely unhealthy housing market. Kevin, where are we now? Are we savagely unhealthy? Has the housing market recovered? Are we in a healthier spot now? What are your thoughts on the general kind of health of the U.S. housing economy? Not to say that there's, if it's unhealthy, that does not mean that nothing is getting done and that it's all doom and gloom. But in that characteristic, how do you see the housing market today?
The way Logan talks about it is when he says unhealthy, he means that there's not a lot of homes on the market, right? So that's what he calls unhealthy. I think we're in a somewhat healthy housing market at the moment. I think things are taking a little bit longer to sell. I mean, first of all, real estate is so local. If you plop us down into 5 different cities, we can have 5 different discussions. And then even when you're in the city, you got to talk about the neighborhood. You talk about the neighborhood, you got to talk about the property type. You know what I mean? Like, because there's price points at different property types, and that drives everything. So, big picture, I mean, in the last 3 months, I think I've been in like roughly 5 of our markets, let's say, in terms of Renovo markets. And overall, people are doing things. I mean, they're buying and selling things. Closings are happening. Rates are a little elevated. Obviously, people have to work hard right now. You got to work hard because you got to be able to make numbers work. You got to be able to find, labor and materials and source things. And you have to be creative. Buyers have a lot of choices today. What we do see is if you're a home builder or a rehabber and you build the wrong house in the wrong location, you're going to pay for it. You're going to get whacked pretty hard because your house is going to sit on the market and it's not going to sell very quickly. So that product market fit, if you're a builder or a rehabber or investor and your product market fit is not right, you're gonna get hurt. Coming out of COVID, when rates were 2.5 or 3%, and everyone wanted to buy houses, it was a little bit of a frenzy, and you could have got those things a little more wrong. Right now, you have to be a little more right, quite a bit more right, I would say. And if you can do those things, I think you will sell houses, and you'll be good. And the other side of the housing market is the rental market, which was kind of frozen for the last 18 months, or at least on a little bit of ice. And that seems to be showing some real signs of thawing out. And the rental market is kind of heating up in a good amount of markets. The other thing that's kind of funny to really look at is the cities that were really hot, in COVID and coming out of COVID, have kind of thawed a little bit. And the markets that were, doom and gloom, people were exiting the cities and people were leaving the older cities in America. That story has kind of reversed ish. And in a lot of ways, the older cities like the Bostons, Phillies, DC, Chicago, and others um, are having a bit of a comeback right now, and they're feeling pretty strong. I sit in Chicago, and I don't think the Chicago housing market has felt as good as it does. And I'm not saying it's like off the charts, explosive, amazing. It's just good. Like I don't think it's been this good in a long time. And I feel that in Jersey, in Boston, in New York for sure.
Yeah, it seems like a lot of the new, like the Northeast, to your point, some of the older cities like Chicago that have been experiencing population declines over the last number of years do seem to be kind of coming back, and those kind of, you hear those and lumped in with kind of the best performing markets. Home price appreciation in Chicago, I think, is higher than it's been in like 30 years or something.
I mean, the fact that Chicago is on the top of the home price market charts is pretty amazing. It just shows that everything goes in waves. I wouldn't bet against big cities or vice versa. It really comes down to know your local market and stick to it and figure out how to go through the ups and downs. Because the people that ran away from the big markets, I mean, you can't run back. And the people that are there just doing their business every single day are going to have ups and downs, just like a stock market participant, right? If you're a hedge fund manager, or you're a trader, you're trading a certain thing, you're going to have ups and downs. And I kind of view real estate as a longer version of that, and just kind of stick with it and keep chiseling away. You're going to have ups and you have downs.
Yeah, and I think you hit on something there, that element of focus, right? I think one of the things we've learned in running Renovo, and how really focused we are in specific markets. We don't just lend everywhere. We really try to get really deep in particular markets and know them really well. And then our lending teams really focus on the markets that they know the best, which is the one that they live in. I think that has never been more important when you run into volatility, right? The word of the day feels like is volatility, right? With this administration, the past version of this administration characterized, I think, in many ways with volatility, right? A lot of things happening, not a lot of preparation, or not always the most careful messaging to prepare the markets. A lot of surprises. And I think in times like that, it's really important to focus on what you know really well, and probably not the best time to venture out into new things, whether it's a new market or a new product, right? And I think that advice works really well, I think, right now, especially because, to your point, I think the folks that are really heads down and are paying attention and studying the market to be able to put the product on the ground that people will actually buy, can afford to buy, those people are going to be successful. And we have a lot of those folks that we work with today. But I'm curious, Darren, what are some, if we were handing out mid-year awards, if this was an award show and we were handing out awards to kind of the top performing markets in the country, what names would be on that list in your mind?
I think New England would get that award. Now, I'll say there's relative value everywhere, and every market has a challenge. I think New England's challenge is supply. You hear from a lot of borrowers that they're having increasingly more challenging to find the deals. But in terms of profitability and quality of the deals, very high. I mean, I think New England, Massachusetts, Rhode Island, Connecticut, those markets have done really well. I think Chicago has been, they probably get the steady as she goes award. especially in the suburbs of Chicago, I'd say. And, to Kevin's point earlier about being local, there's parts of Chicago that, prices have fallen or are lower, i.e., like the condo market in certain parts of the city. But if you go out to the suburbs, it's never been hotter. I mean, you could get 10 plus offers on a flip in any of the Chicago suburbs. I think, the Pacific Northwest has been incredibly strong. I think California would get the resiliency award. You know, lots of news about insurance and fires and all of those things. Yet when you pull back the tape, home values are basically the same. And there's a ton of resiliency in California. So I think, those 4 or 5 markets I would say would win awards at the mid-year gala, the market gala. So from my perspective.
All right, so Kevin, we just got some of the best performing markets from Darren's perspective. I'm curious, do any markets come to mind if we were talking about some of the lagging markets, some of the more challenged markets that we lend in, and we don't lend in every single market, although we do cover most of the country at this point. But in your mind, what would be kind of some of the bottom performers in terms of current state of some of these regional markets?
Look, I'm such a believer that you should just do business where you're at, if that makes sense. Like, I think there's money to make in all the markets if you're local and you stay focused, especially if you're in a large city. If you're in a really large metro, you should stay focused. You're probably not going to be able to time. Who's going to be able to time the market? Not many people, right? Like, we're not market timers here, especially when you're dealing with real estate, which is like a 1 to 3 year asset you're not going to time Trump's next move. You're not going to time interest rates, probably. You're going to build a business, hopefully, that could withstand some turbulence either way. And I just don't want to lose sight of that, honestly, like, because it's kind of course it's fun to talk about different markets, and I'll give you my thoughts, but I'd rather be an A+ operator who's been in business for 15 or 20 years in any major US market. How's that? Who really knows what they're doing and has dialed in their systems, has saved some money, and has great relationships with everyone they do business with. Like, that's my prediction of who's going to win.
That is a great answer, and it's also one of the best non-answers I've ever heard. So great job. And you're right. You're absolutely right.
I'm not meaning to be an odd answer. I think, look, the 2 markets that I think I hear most about are probably, look, I'll say it. You're sitting in one of them.
It was a leading question.
Well, look, last time I was in Austin, I honest to God, haven't felt the feelings that I felt during the GFC at all since the GFC and when I was in Austin last time. When I was in Austin last time, you were driving us around, or I think it was either you or Mariquin. We were driving around, and we pull in front of a house, and I was like, "How much is that house?" And we were getting out, and you're like, $6 million, and I was like, "Really?" I gotta tell you, it doesn't look like a $6 million house anywhere. And then I look across the street, and there's an empty lot with shopping carts and a mattress and a TV just sitting in the lot. And I'm like, this is not a this borrower is full of shit, and this $6 million house is never going to sell at $6 million. So it really had the feelings of like a lot of bad mistakes, to be honest. When I was there last time, what makes a bad housing market from our point of view as builder finance people, it's a lot of mistakes, not having market fit, going too deep into a risk. Like, did you have to build, I'll say this, I was in Tampa 2 weeks ago, and I saw a house that was going to be asking $3.5 million on a block that I think you can pick up vacant land for 200 grand. I don't think this is a $3.5 million house. to be honest. And I don't think someone pulling out of a $3.5 million house wants to stare at a house that's on the market for 180 grand. I think those things are very important, like fundamentals in real estate, just like residential real estate fundamentals, product market fit.
No, I think you're right on. And I definitely asked the question, assuming that we would talk a little bit about Austin. And it's interesting. I think Austin fell victim to the frenzy, right? It was so hyped. There's so many people moving here. I mean, we've had so many people moving here for over a decade. But when the post-COVID kind of rush happened, I think a lot of people got very drunk on, oh, you could price this thing anywhere you want and it will sell in a day.
Absolutely.
And build anything you want. You can build anything you want wherever. That's the fundamental, right? You can build anything you want wherever you want, and the guy from California moving here is going to buy it anyway. Don't worry. The good thing about the old markets like Chicago, New Jersey, and Boston, nobody's moved here from other places.
The traffic is too awful. Yeah.
So the people who are buying, well, maybe, but the weather sucks, right? I mean, so no one's moving here for the weather, or the lifestyle. My point is that the buyer pool kind of knows what they're buying. And you kind of have to, as a developer, you kind of have to meet the market where it is. What Austin was able to do and certain other markets are able to do is you guys, you can get speculative, a lot more speculative. You really can't get that speculative in these older cities because you don't have you don't have tons of buyers moving here from out or moving to any of these markets from out of, the California buyer. You don't hear of a lot of California buyers going to Philly.
Yeah. And I think said a different way, it's discipline or the erosion of discipline, right? And so I think, both on the buyer side, discipline got kind of thrown out the window because people wanted to move here so badly, they were willing to buy anything. And of course, that was overheated with ultra low interest rates. So it was very cheap to buy in terms of interest rate cost.
In a perfect world, as you would, sorry, James, I just don't want to lose that thought you were saying right there for a second. Like, that's where a good disciplined home builder or home flipper will make outsized returns. Awesome. Go make outsized returns. You don't have to take outsized risks all the time to make those returns. You could just play your game and build what you build and know what the market will absorb. And then you're right. If people are just moving in like crazy, great, you're going to get more money. But if you build that elephant of a house in the wrong location and you just think there's a greater fool theory, right? It's been around for a very, very long time and it shows up every time there's heat, there's a exuberance in the market. It shows up every time.
I think that's right. And I think what you saw, because I remember when we were driving around on that trip and we were on the east side of Austin. The east side of Austin has been under redevelopment for the last 15 or 20 years, but it really heated up in the last 10 years. And that's where a lot of speculative investment was happening. And I think what you saw was there were people that were in those markets putting up these homes and they were making a killing on these deals. And I think what you saw was a lot of investors losing discipline over what actually kind of made sense so that they could cash in on that trade. And unfortunately, what happens is at some point the music stops and there's someone left holding that bag. And hopefully for a lot of these investors, they made so much money on all those deals they did in 2021 that they were able to absorb some of the losses that they might have seen in 2024. But, there certainly has been quite a bit of pain. And we're feeling that, right? But to your point, again, the right neighborhoods with the right product market fit, those deals sell, right? And good school districts, like all the fundamental stuff that you think about as a real estate investor. There are parts of town where prices are fine, but there are other parts of town that were more speculative that has certainly been hit harder. And I think that story has played out in a number of markets. Austin kind of being probably the favorite of the pundits to talk about. But that said, for the right investors that understand the market, understand affordability, they're finding deals and they're finding success. It's just a little bit more strained at the moment. But I think it kind of also goes back to the longer term mindset, right? The people that have longevity in mind for their business probably weren't taking some of those risks and were more focused on more affordable segments of the market and not throwing up the McMansions in I'll call it emerging neighborhoods where that has historically not been the composition of the neighborhood. That's where people start to get into trouble. And I think it's a great lesson for any investor out there that is kind of thinking about how to evolve their business. You've got to really you can't get too drunk on, oh, the market is amazing and people will pay whatever. Because that does stop at some point. Like the balance has to come back. And Austin's avoided that for a long time because we had a lot of affordability here because of the abundance of land and all of that. But that is not nearly the case today, and definitely been some pain. We can move on from this topic because I think this has been a good one, but would love to talk a little bit about interest rates. I'm sure a lot of people who listen to our show, a lot of our clients and partners, certainly very interested in what rates are doing, where rates are going. I believe I saw a few minutes ago that the 30-year fixed rate mortgage for consumer mortgages top 7% today. What are your thoughts? And Kevin, we'll start with you. What are your thoughts on rates? A lot of people anticipated with Trump coming in that we would see rates come down. We have not seen that. A lot of the things that are being talked about policy wise appear to be pretty inflationary, and certainly tariffs and immigration policy sort of feed in here at some point. But what are your thoughts on rates and what we can expect as we look at the second half of 2025? With regard to interest rates for consumers and for investors.
You're going to accuse me of another non-answer because, I don't know. I operate from the mindset that none of us know, and it makes. I think if we're going to be in business and we're going to be in real estate and finance, that you have to be able to operate, with at least without hoping that I hear a lot of hope. I'll say that. I hear all kind of hope. I don't know what hope gets you in this world. Now, I do think what we're seeing is the cost of money is an input. People are still making money today, plenty of it, and it's an input. Yes, the cost of goods is higher, cost of money has been higher, and it's an input. It's a cost to do business. The 2% and 3% rates were never real. I shouldn't say they weren't real. Of course they were real, but they were those were special. Money was on sale during that period of time. And, right now money is kind of a normal price today. 7% mortgage. I don't know. I'm not that. I'm in my 40s and my first rate was 8.5. I'm not in my 60s, 70s, talking about when rates were, 18% or whatever. But my rate was 8.5. I didn't know any different.
And Kevin, I think you're exactly right. It's an input, right? It's one cost. I think where we have the friction today is that we've got an elevated pricing situation where home prices really inflated significantly, post COVID. And then because of the supply demand imbalance, not enough homes, a lot of very interested buyers, those prices are holding, right? So you've got elevated prices and elevated rates. And then of course we've also got now the potential for, in some cases, significantly elevated materials costs, and then potentially labor cost implications as well due to additional policy. So I think it may be a good time to kind of touch on those things because Kevin, you and myself, go ahead.
Well, one thing that I think is true that I heard recently, and I think about this all the time. So the sellers, like the business sellers of homes, whether it's a builder, I mean, a homeowner can't really do this, but I guess they could. People should be buying down mortgage rates today. The builders are doing it. The home flippers, I'm not sure if they're doing it to the extent they can. Meaning, and what I mean by that is get with your local mortgage partner and figure out how you could pay a fee as the seller of the home to buy the rate down for the buyer to move that home. Do you know of any? I mean, James, do you hear about that much at the? You're a member of a lot of the mastermind groups in this country. Are you hearing people talk about that?
I have heard a little bit about that. There's a guy that is a big build. Well, I wouldn't call him a builder. Maybe he is a builder, technically speaking. But anyway, big investor in Kansas City, and he was doing that. He was buying rates down and then offering lower rates to the buyers of it. Primarily, he was developing turnkey rentals. So he was building, getting renters in there and then selling those rented units to investors. And so he was going out and basically buying down big chunks of rates. I actually, on Saturday, I had dinner with a land developer friend of mine who lives in Charlotte and primarily develops land in the kind of North Carolina, Southeast, but a lot of North Carolina. I think he said he's got 6,000 lots in his pipeline or something like that. And he's selling these once he's got the lots kind of platted and they're ready to go vertical. He's selling these on predetermined contracts with public home builders. And I think he told me, and I'm probably going to misremember the name, but it was one of the publics. I want to say it was Lennar or Toll Brothers recently bought $3 billion worth of interest rate buy downs from on the open market, like very recently. So we know the home builders are doing it, and they're doing it on a massive scale because for them, they're in the business of selling homes, and the lower they can get that rate, the faster they can turn that product, and they can realize gains on all that, right? And keep the machine running. Smaller investors don't have that as much, but they still have a version of it. And we can't hear you again.
I have a feeling Kevin's going to be walking over here.
Is he coming?
Yes.
I knew it. I knew it.
Yeah. Come on in. Pull a chair.
Yeah, that's what I'm doing. Plug it. I'm going to sit on your lap. I'm going to sit
on my lap.
Can I sit on Darren's lap?
Yeah, ask HR.
This is a lot technologically. This is better. This is technologically easier, I'll tell you.
All right, so we've had a little musical chairs because Kevin has been having some difficulties with his microphone in his office. So now Kevin and Darren have teamed up. It is 2-on-1 officially. So we'll jump. Yeah. Well, yes.
Who's Karen or Devin? We're combined now.
Oh, yes, we're combined. We are one. We are one.
I'll let you guys decide which name you want to go with. So we were talking about interest rates. Kevin, you were about to say something incredibly profound, I could tell, and then your mic went out. So really we'll kick it back to you.
Look, all I was going to say, and then let Darren take the interest rate thing. It'd be kind of neat, like if the big home builders are doing it, why couldn't a group of smaller builders or smaller developers be thinking about that also? So I would assume I'm surprised it's not happening more often. When I first got involved in real estate in early 2000s, this kind of the creativity, I'll be honest, the creativity was higher because the financing was more limited and people would do things like that. It wasn't that uncommon. So I'm confused actually why some of the groups, let's say just pick a region, maybe 5 home builders get together, go meet with your mortgage company, figure out a program, buy down your rate, and offer homeowners who buy your product a better rate. Why are we not? Why are they not? I mean, James, you probably need to bring that up on one of the next masterminds that you're on. Like, why? And look, not for the people that are flipping to other investors. That's not as impactful. I'm really thinking about the people who are selling to homeowners. Why not get that homeowner a better rate and do it that way?
and I don't know the ins and outs of this, right? Like I have not done a deep dive on this topic necessarily, but the gentleman I was referring to in Kansas City, a guy named Mark Delator, awesome guy. As Mark was explaining it to me, what he did was he reserved an allocation from, I don't know if it was Fannie or Freddie, or I don't exactly know how that part worked, but he basically paid for a rate buy down on an allocation of loans that would go to the end buyers of his homes. But he had to use that allocation within some period of time. So there was like a risk that he was taking on, that if he didn't sell enough of those homes, that he basically, that allocation would go unused, and his cost to acquire that rate buy down would be amortized over fewer.
Yeah, I mean that happened in that sounds like a big boy way.
Yeah, it's a big scale.
There is a more user friendly, may not, and look, he may have gotten more bang for his buck that way. He probably did. But you could definitely go and cut a deal with your local mortgage shop and say, hey, I'm a home builder, and me and my 5 buddies, we sell 100 homes a year combined, or 300 homes a year combined. How would you, Mr. Local, Mr. and Mrs. Local Mortgage Group, like to partner with us? Tell us what it would cost that we can offer our clients. Instead of offering them 7, I can offer them 6.25. What would that cost us? They will tell you.
I think that's a great idea.
It's not free. It's not even close to free. It's wherever free is, it's the opposite of free. But but it's, to me, it's part of what should be happening today.
I think it's a great point. Maybe we should have Mark Delator on an episode of the show. He could talk about how he did that.
Well, either that or get a mortgage person on who actually does this every day. Like,
that's good.
Because the way he did it, no one normal is going to do it. He's doing something very bespoke. This happens on a smaller scale every single day, but not enough, in my opinion. I really think we should get a mortgage person on here who can actually explain how to do it.
I love that. Look at that. You go away for a minute with the technical difficulties. You come back in.
Well, now I'm fired up. I'm sitting next to Darren. Keeps grabbing my legs and
hands above the table.
Feeling uncomfortable, very uncomfortable right now.
No, that was great though. That's a fantastic nugget. I think that's very actionable and definitely something we should talk about some more.
We were talking about Austin earlier. Like, a lot of builders in Austin actually went down this path when they had trouble moving inventory. They would set up these kind of rate buy down programs. A lot of borrowers did this. It really helped them move really sticky product. Because really the math goes like this. If it costs, let's say you want to offer, James Gaskin a 75 basis point buy down, I can go to the bank, I can go to the mortgage professional. I know how much that costs, X. But the other cost of just sitting on it could be much bigger. Property taxes, insurance, maintenance, all of those things can be much bigger than the rate buy down. So I think what I hope borrower, Kevin mentioned creativity. What I hope folks do is look at some of these other solutions, because we've been talking about rates. They're not going to be moving around that much, right? Like the kind of thought that home prices will appreciate, rates will go down, these things will solve my pricing issue, it'll solve my ability to pay off a loan. That's going to be much, much slower than some of these other creative kind of solutions that will actually save them money.
Yeah, and on top of just the added interest expense, right? I mean, you could just look, you could pull out those costs very easily, right? The interest expense every day, you have a burn for your construction loan, right? And then, of course, the longer.
Think of it like this, too. I mean, if someone came to us at Renovo and said, hey, we've got all these homes we want to do every year. We're a great builder. We're really qualified. We want to do all this stuff with you. And then what do they say next?
What rate will you give me?
How good of a deal can you give me?
Yeah.
Here I am. I got all this volume. How good of a deal can you give me? I am kind of sure you can go meet your local mortgage group and say, hey, me and my friends here, we sell X amount of homes a year, which is going to equal 50 million in mortgages, 60 million in mortgages, without even a buy down. What kind of deal can you give us? Yep. Then start with the buy downs, and then really push on them, because look, the mortgage companies are also kind of starving for business.
Yeah.
You know, this is a real roll up your sleeves moment and work hard. When I said earlier about working hard, this is the kind of work I'm talking about. Like, by the way, it's like talking to people and pushing buttons. It's not that hard. But I would think that'd be a fun discussion. James, I think we should try to get a mortgage person on here that knows this niche that could talk to us about it. That'd be kind of fun.
I love it. I'm already working on it. So we talked about rates a little bit. I think one of the other, big things going on right now is, tariffs, right? Tariffs are all in the news. Trump says tariff every 20 minutes, I think.
Most beautiful word
certainly,
in the language.
It's a big, beautiful word. And so, I think the impacts of tariffs, number one, have not been felt, right? There's been some things happening, but I think a lot of wait and see, right? Kevin, I know you and myself, we both travel around a lot to different markets and talking to investors. And I ask people everywhere I go, how are you thinking about it? Are you thinking about it? And, are you doing anything proactive to prepare if there's a worst case outcome on things like tariffs? And I think the other piece of it is immigration policy and what that could do to the labor force that a lot of construction, disciplines rely on, and then the corresponding increase in labor costs. So how are you guys thinking about that? Are there any things that you're seeing that our clients are doing proactively to prepare that you think people should be thinking about more?
First and foremost, just to confirm what you said, like if you look up the purchaser price index, PPI, it's basically unchanged since 2020. So as much as you read in the news about tariffs and explosions and this country called me and they're ready to make a deal, if you go pull up the PPI, it's basically flat since 2020. So one is just knowing what you know. And I think if you work with specific suppliers, proactively have a relationship with those suppliers. Have them tell you what, their cost structure is looking like. Where are they sourcing their materials from? I think these estimates are basically guesses, but you could assume maybe if all of these things were to hit in various different timelines, 5% change. So that's not going to destroy a business. So just have a good relationship with your suppliers. Make sure you know your costs. Do detailed budgets that you and your lender can have discussions about line by line. That really helps. In an environment where costs can go up, you don't want to have kind of preventable mistakes like not knowing your budget, and knowing how much each line item is. And then lastly, don't do deals if they don't show a profit. Quality over quantity. And if you do a deal that has a solid profit margin and costs do go up, you'll still make a profit. So I think it's pretty basic, but I think just focusing on those two things will really help.
Yeah. And I think, the communication thing is really smart. So I know we had a deal that we closed, I think it was last month. I want to say it was over $10 million. It's like a $12 million loan. And I want to say Atlanta for a ground up condo build. And the day before closing, the borrower called up and said, "Hey, I got my lumber supplier called me, told me prices for lumber are going to be 30% more than what I initially thought." And of course, they wanted to change the budget and all of add to the loan amount, right? Which at the day before closing is not really feasible thing to do. Sure. They had to go back to their supplier and they had to cut a deal. And they didn't end up back where they originally thought, but they weren't at 30%, markup. So, they were in the middle. And I think what you're saying, Darren, is really smart, is being proactive about those conversations, making sure you build good relationships with your suppliers so that you can have that conversation if the need arises to mitigate some of this. And I think the same thing exists for the labor side, right? Knowing your contractors, talking to them about their potential exposure. Are there things that they're thinking about, concerned about, and just having an open dialogue? Because the reality is that nobody knows what's going to happen. And I think that if there is, major fallout or impact from this, we're not going to know about it until it happens. And then we're all going to the key is don't be left, scrambling because you haven't thought about it at all and just assumed everything was going to be fine.
Well, and don't freeze, right? Like what Darren is saying is pick up the phone, talk to your suppliers, go get with them, go have lunch, ask them what's going on, and cut deals and figure out a way to have a win-win solution. This is when people have to roll up their sleeves together, just like we talked about on the mortgage side. It's kind of the same thing on the supply side, right? Like, hey, get a couple of your builder buddies and go meet with the cabinet people. Go say, hey, what can we do? Anything we can do here together as partners?
Yeah, and I think the important thing is doing that early and not waiting until the pain happens and then trying to go and work it all out, because you're going to be one of hundreds of customers that are doing the exact same thing. Get ahead of it, right? And Darren, I think you made a good point, like understanding your budget, doing a really detailed line by line budget, and then looking at that budget and going, all right, where are my pinch points? Like where are some of these materials? Like, oh, I know, appliances, a lot of these appliances are coming from overseas. I should probably call my appliance guy. And it just start to have that conversation, lumber, right? Other things. And, that might lead to a change in vendors. Like, hey, maybe this vendor doesn't make as much sense as it did before because I feel like I've got more risk because they source a lot of things from certain countries that may be under fire from tariffs, right? Like, I think being proactive is a big takeaway and should be a thing that a lot of people are thinking about. And I'm always surprised when I go to these events and I talk to investors, on the ground, and some of them are not thinking about it at all. And I think that's a mistake, at the very least.
Everyone thinks differently about what I'm about to say, but I think in any business interaction, like relationships really, really matter. And if you go and want to beat the shit out of your supplier right now,
you'll be last on the list.
You probably will be last on the list to get some help, right? I mean, this comes to everything is relationships still. We're in a tech fast world, which is awesome. AI, awesome. Sometimes you still have to go meet with people, and there's relationships that could be win-win. And if you take the time to listen, and by the way, maybe it's starting out by asking them how their business is doing. Hey, can I ask you how your business is doing? What's going out for you guys? How are you feeling about everything? They might go, hey, we're crushing it, by the way. We bought a lot of stuff a long time ago. We're doing amazing. So, oh, wow, that's good information to have. Instead of walking in, so there's an old expression, seek to understand before being understood. So it means see what's going on for them before you go in guns blazing and asking for things. And remember that relationships matter a lot. And if you're going to be in the geography that you're in, and you're going to be dealing with the business type that you're dealing with, you probably could be dealing with the same vendors for 20, 30 years. You can get through a lot of stuff together, a lot of ups and downs, a lot of things you can get through if you work together back and forth. And you don't nickel and dime them for every single thing is kind of what I'm trying to say also. Is, when you're that person, everyone knows who the customer is. That's low margin, high aggravation. Right? And those are the ones you kind of, fine. But are you going to go out of your way to help them? Maybe not. There's
a whole business philosophy about firing the bottom 20% of your client list. Then those are the ones that are high or low margin, high aggravation, right? And not being in that camp.
You go to some older, wise business people, they would say, go have some discussions, ask questions, build relationships, show them you care. When times are good, by the way, when you were crushing it, did you thank them? Did you do anything nice, or did you just take it for granted and expect them to now bend over backward for you? I think relationships matter, and it's old school, and it's getting fewer and fewer people that I think about that every day.
Well, one thing you said that I think is really important is looking for the win-win, because I think the whole being a difficult customer, like the objective should not be to grind down the counterparty until they're basically losing money for you to be able to make yours. It's going into those conversations. Number one, I think with that seek to understand attitude, building a relationship with the counterparty, not just about what are you going to give me. There's fundamental old school ways of just building a relationship with somebody, and then looking for that win-win. Because if you're the only one winning, you'll find yourself, without a partner at some point, right? That's just kind of the way it goes.
Yeah.
So I think that's great, guys. We have just a couple minutes. I know, Kevin, you're about to rush to something.
Sorry, I really got to go quick. So okay,
that's okay. We're gonna do a fun thing to end the show. I'm gonna select a random article from today's Wall Street Journal.
Cool.
And I want to get 20 seconds from each of you on this article. We're gonna see how this goes. This could be a total flop, but let's see how it happens. So I'm just going to pick a random section, not looking. Oh, I happen to click on real estate, so that's good for you guys. Because had I clicked on sports, I don't know what we would have had coming up.
Oh, I thought you were going to talk about the Pope or something. I thought we were coming.
No. This is just going to be a random article.
Sciences okay.
All right. Well, this one is probably something you guys can talk about here. Miami Beach's historic Art Deco district collides with push for more housing. I mean, this is perfect. This really was random, I promise. So this is happening in a lot of cities, but I think some of the historic areas, like you've got, obviously we have a big need for housing. Some of these historic areas have some room for development. How do we think about some of developers and borrowers in historic areas? Are those, Darren, do you see more risk in things like that?
No, I don't see more risk. I think if I've got 20 seconds, I think probably the article's about, in a lot of historic districts, you have probably a few people that own a lot of the real estate. And, historic areas have charm and culture that's important. And the idea of developing it means change, right? And change can be scary. And I think that's really the heart of that argument and that discussion nationally, all over the country. And I think specifically for Miami and Florida, before my 25 seconds is up, is, buildings over 3 stories are a problem. So if that development, were to say be a condo, right? There's a lot of new laws about condos in Florida that makes them very onerous as an investment today if you were to start brand new. But I think that's probably what the topic is about.
Yeah, it's definitely the article is about a push to redevelop and basically knock down a bunch of the historic Art Deco buildings and then replace them with affordable housing, with high density. So it's a push for affordable housing.
Oh, man, I would hate to see some of those cool Art Deco buildings go. That's my comment.
I know you're a big Miami fan, Kevin.
I was gonna say I love Miami. There's very few places in America like Miami. That's just very cool. It'd be important to preserve. I think you can do it. You can have a win-win. You can definitely find a way to create some more housing, save most, if not all, of the Art Deco buildings.
Yeah.
Florida's got a lot of land left, by the way. You don't need to build on Miami Beach if you really want to get started in a discussion. Do you really need to be having more housing right there? I mean, there's a lot of land to build on.
I could not agree more. And hopefully we can find a win-win, because those are some beautiful buildings. And I think, obviously we have a huge need for affordable housing, but there's lots of ways to skin that cat for sure. Guys, this was really fun. I know.
Awesome job. Sorry, we got to get my computer fixed next time. I got to go.
Thanks, guys. It was awesome having the conversation.
Awesome job, James. Thank you.
Thanks. Look forward to doing another one. Hustle harder.
Thank you.